This is not financial nor professional advice. This video is for entertainment only. Hey everyone, today I want to give you some perspective on the stock market as a trader, a swing trader, a long-term trader, and a short-term trader, and an occasional day trader.
It's called being talented.
Just what is my view on the market and what is my plan and overall strategy at the moment. I find myself becoming increasingly short-term because it's difficult to plan a long-term strategy, but I'm also doing some trading, and I've resorted to day trading simply because you have these bull traps appearing, and that's where the market is declining. Then all of a sudden it starts to pop up, and you start to think, "Oh, it's back."
That is bullcrap.
The long horns of this bull market. We are in a long-term bull market, but we have these short bear swipes at us. The bear is lurking in the woods to take a swipe at us at any time. And when you see the bear start to emerge, you get out and you sell. And the way I day trade this is I day trade stocks that I know well, that I tend to know how they move. My two favorite stocks to day trade, because I know them so well, I follow them every day, is Tesla and Berkshire Hathaway. Now, in the short run, I make some money. In the long run, I probably still make money, because if I'm wrong, I'll just hold the stocks until they do go up, and they eventually always have eventually gone up. So there's not much risk with that. So I think it's a pretty good strategy. Overall, we are in a strange situation. The stock market is much more related to the bond market than you probably think. We get so focused on stocks because it's the place to invest for right now. Maybe the only thing except for real estate, and most people don't have enough money to really be investing in real estate in a big way, unless you're doing REITs or it's conservative REITs or something like that. That's possible. So you're left in a situation where you start to believe, yeah, the stock market is it. The stock market is where it's at, and that's not really the case. The bond market in the United States is twice as large as the United States domestic stock market, the entire stock market on all levels. So the USA bond market is about 40 trillion. The stock market, all of it, is about 20 trillion. On a world basis, the bond market, what you have to learn is that the world runs on debt. Debt is how money is created. When you borrow money to buy a house, and you get that from the bank gets the money from the Federal Reserve, and the Federal Reserve creates money to give to the bank. So your debt is literally creating money, and that's why the world runs on debt, and that's why it's such a big deal what interest rates are. So the entire world debt market or bond market is over 100 trillion. Okay, and it's related to creating money, and if people aren't borrowing, you have less money, and in which case the Federal Reserve starts to inject money into the economy, which they have been doing, which is really pathetic given how low interest rates are. if at any other point in my life, in the 80s, in the 80s and the 90s, if you injected this much money in the economy, you would have interest rates at over 10%. I remember, I had a 30-year mortgage on my house to begin with, and I was just thrilled to be able to refinance. I think the loan was like at 8%, and I refinanced it, and I got 7%. Boy, what a low interest rate! Now people would be taken back on their heels to hear that kind of interest rate. And I remember buying a life insurance policy, and they guaranteed that it would always pay. The minimum it would always pay is 4.5%. And at the time, interest rates were running 9 and 10%. I remember almost laughing to myself, interest rates will never go below 5%. So that's ridiculous. But it turned out that was a great insurance policy. So this is how much things can change. So we're in a situation where people don't really realize how much they can't raise interest rates much. And the reason is partially because of the national debt. I mean, we're coming up close to, I think it's like 28 trillion. We're going to be close to 30 trillion when they get done with these infrastructure bills. And it looks like they're not going to pass the second one, which would raise it another 3 trillion or whatever. But it's at least 28 trillion. But, if you have a high interest rate on that adds to the national debt. You add 5% interest rate to that, and all of a sudden you're adding like 4 trillion more to the cumulative national debt per year. So in many ways, they can't raise interest rates much. So there's that long-term deflationary effect. The other thing is the bond market disagrees with rising interest rates. The 10-year bond, and you want to keep your eyes on what the 10-year bond is. People panicked when it went up to 1.7%. Wow, what an interest rate. Boy, we're edging up to 2%. Wow. That's like nothing. It's like a nothing interest rate. And people are getting excited about it. Well, this is what you have to ask yourself. The Fed has promised they're going to try to raise it 3 times and get close to 1% by the end of next year. Okay? The bond market, I think, disagrees or does not think it's going to be as much as the Federal Reserve thinks it's going to be. The 10-year rate has been about 1.5%, and below that 1.48, 1.45 I've seen. It's ridiculously low. And this is when the Fed is openly saying we're going to raise rates. And I think the reason for this is I think the bond market is anticipating a recession. And I think they're anticipating a recession because of the health of the country and the difficulties with the flu. And this is a worldwide effect. It's not just the United States. And so the bond market begs to disagree. And they tend to be the canary in the coal mine, the early warning signal that something is going wrong. And they tend to be early, okay? What they signal usually happens about a year later, 9 months to a year later. So it isn't always exactly on point, but there's usually a delayed effect to it. So I think the main danger is recession. And also, technology tends to have a deflationary effect. The long-term effect of technology is deflationary. And you can see this with your technology that you use, your computers and stuff. They get twice as good and half as expensive, every couple years. You wait a couple years and you'll pay less money or maybe the same amount for a computer that'll do, twice as much as the one you had before. So, and technology tends to do that. It's like with electric cars too. I mean, they've eliminated the mechanic out of my life. Unless if I was involved with cars repair, I would be doing body shops, because you're not going to have that much repair work on an electric car. I mean, it's going to be replace the battery or work on the body of the car, and replacing the battery is not an intensive business. I mean, it's the cost of the battery, and those are going down in price as they get more efficient, and they need to use less materials, and they're able to store more energy. And fuel costs to run an electric vehicle is about a third of what it costs to run a gas-powered vehicle. And that's why electric vehicles are going to continue to take off. So you have these long-term deflationary effects. As far as energy goes, I'm in Arizona, okay? I'm in the ideal place for solar energy, and this will not be the case for everyone. But I don't pay as much for energy. I have solar panels, okay? I'm creating more energy probably than I use. So, it's really a boon to me, technology, but it is a deflationary effect. I'm paying less and getting more. Thank you for watching this video. Be sure to hit the like button if you found some value in this video, and comment and let me know what you think. I enjoy getting feedback from you. And also subscribe so that you receive future videos. In my next video, I'm going to be talking more about what part of the stock market might be something to look at right now, which hasn't been something to look at for a little while here. So I will plan to see you in the future and hope to offer you some good advice of what I'm doing, which might be applicable to you, which might not be applicable to you. But I do try to make it so there's something in my video maybe for everyone, depending on your situation. But only you can know that for sure, because I don't know your personal situation, of course. I will plan to see you in the future. Thank you.